There's a good chance that something you firmly believe about your credit score is wrong. Not kind of fuzzy wrong. Costing you real money wrong. The kind of wrong that shows up as a higher interest rate, a denied application, or a number that just won't climb no matter what you do. Maybe you've been carrying a balance on purpose, thinking it builds your credit. Maybe you're afraid to check your own score, so you never look. Maybe you just closed a credit card you'd had for 10 years and felt responsible doing it. Here's the thing, none of those instincts are crazy. They're just based on myths that get repeated until they sound like facts. In the next 10 minutes, we're going to take the 5 most common credit score myths and run them straight into the actual data from the people who build these scores. By the end, you'll understand your score better than most adults ever will. Let's fix some expensive misunderstandings. Myth number 1, you have a credit score. Singular. One magic number that defines you. You don't. You have dozens. Here's what's actually true. There are 2 main companies that build credit scores, FICO and VantageScore. And each one has multiple versions still in use at the same time. Older models don't get switched off the moment a new one launches. Lenders upgrade on their own timelines. So a 2014 model and a 2020 model can both be scoring you right now. On top of that, your score is calculated from data at 3 different credit bureaus: Equifax, Experian, and TransUnion. These bureaus don't share a single file. Each keeps its own record of you, and they don't always match. One bureau might have a card the others don't, or an address update the others missed. So you've got multiple scoring models, multiplied across 3 sets of data. Different lender, different model, different bureau, different number. Picture this. You open the free app on your phone, and it proudly shows 742. A week later, you sit down with a mortgage lender and they quote 718. Your gut says someone made a mistake. Nobody did. The app is probably showing a VantageScore built for quick consumer checks, while the mortgage lender pulled an older FICO version built specifically for home loans. Same you, 2 honest tools, 2 different answers. What you should do, stop chasing one perfect number, because that number doesn't exist. Pick one free tool. Watch the general trend, up, flat, or down, and ignore the small gaps between sources. The habits that move one score move them all. So if your trend is climbing, every version is climbing with it. Myth number 2. And this is the one that costs people the most. The belief that you need to carry a balance, paying a little interest each month, to build credit. You leave $50 unpaid, the bank charges you interest, and you tell yourself it's an investment in your score. It isn't. Let me say it cleanly. Carrying a balance and paying interest does nothing to boost your credit score. To see why, look at what actually goes into the score. Your FICO score is built mostly from your payment history, whether you pay on time, and your credit utilization, which is how much of your available credit you're using. Here's the full breakdown. Payment history is about 35%. Amounts owed, your utilization, is about 30%. Length of history is about 15%, new credit about 10%, and your mix of credit types the final 10%. Notice what's not anywhere on that list. Voluntarily leaving debt unpaid so the bank can charge you interest. The score has no slice for loyal interest payer. It can't reward something it doesn't measure. And it gets worse. Carrying a big balance can actively hurt you because a higher balance pushes your utilization up. And utilization is that 30% slice. So the interest builds credit idea doesn't just fail to help. In many cases, it quietly drags your score the wrong way, while transferring money from you to your credit card company every single month. What you should do: use your card normally, then pay the statement balance in full every month. You still get full credit for on-time payment and active use. The score sees the activity, sees that you paid, and rewards exactly that. You just skip the interest entirely. Same credit building benefit, 0 cost. Myth number 3, that checking your own credit score drags it down. So people avoid looking, sometimes for years, flying blind because they're scared a peak will cost them points. Here's the distinction that clears this up completely. There are 2 kinds of credit inquiries, and they are not the same animal. A soft inquiry is when you check your own score, or when a company peeks at your file to send you a pre-approved offer. Soft inquiries do not affect your score at all. Full stop. A hard inquiry is completely different. That's when you actually apply for new credit, like a card or a loan, and the lender pulls your file to make a decision. A hard inquiry can ding your score a little, and only temporarily. So where does checking your own score land? Always on the soft side. Always. You could log in and look at your score every single day for a year, and it would never cost you a single point. The fear is real, but the mechanism behind it simply doesn't exist. What you should do: check your score and your credit reports regularly. Make it boring and routine. You're entitled to free credit reports from each of the 3 bureaus, and actually reading them is how you catch errors and fraud early. An account you never opened, a payment wrongly marked late, those can genuinely damage your score, and you can only dispute what you've actually seen. Avoiding the page doesn't protect your score. Reading it does. Myth number 4, that closing a credit card, especially an old one you don't use anymore, is the responsible, grown-up move that helps your score. It feels like tidying up. Fewer cards, less risk, cleaner finances, right? It often does the exact opposite. Closing a card can hurt you in 2 specific ways. First, it erases that card's credit limit. Remember, utilization is how much of your available credit you're using. And when you close a card, the available part shrinks, while your balances stay the same. Your utilization can jump even though your spending never changed. Look at the math here. Say you owe $1,000 spread across cards with a combined $10,000 limit. That's 10% utilization, comfortably under the keep it under 30% rule of thumb. Now you close a card that carried a $5,000 limit. Same $1,000 balance, but only $5,000 of limit left. Your utilization just doubled to 20% instantly, without you spending an extra cent. Close enough limit and you can blow past that 30% threshold by accident. Second, the length of your credit history matters. That's roughly 15% of a FICO score. And your oldest accounts are doing a lot of quiet work raising your average account age. That dusty card from college might be the very thing anchoring your history. Close your oldest card, and you can lower that average over time, weakening a part of your score you can't quickly rebuild. What you should do: before closing any card, ask one question. Does it charge an annual fee? No fee. Then it's often better to keep it open. Put one small recurring charge on it, like a streaming subscription. Set it to auto-pay, and let it quietly help your utilization and your history in the background. If it does charge a fee you're not getting value from, closing it can make sense. Just go in knowing the trade-off instead of assuming closing equals responsible. Myth number 5, that earning more money raises your credit score. Get a raise, get a better number. It sounds completely logical. It doesn't work that way. Your income is not a direct factor in your credit score at all. A 6-figure salary and a part-time paycheck are invisible to the formula in exactly the same way. Credit scores are built entirely from how you handle credit. Paying on time, how much of your limit you use, how long you've had accounts, your mix of credit types, and how recently you've applied for new credit. Every one of those is a behavior. Your salary isn't in that formula anywhere. The score simply doesn't have a field for it. Now, income absolutely still matters, just somewhere else. When you apply for a loan, lenders look at your income separately to decide whether you can afford the payments. That's a real check, and it can make or break an application. But it's a different question from your score itself. The proof is in the comparison. A high earner who misses payments can easily have a worse score than someone earning far less who pays on time, every time. What you should do: focus on the behaviors the score actually measures, not the size of your paycheck. You can't out-earn a bad payment history. But the flip side is the encouraging part. Anyone at any income can build a strong score with consistent habits. The formula is the same for everyone. So let's lock in the correct mental model in 5 lines. 1. You have many scores, not one. So watch the trend, not a single number. 2. Carrying a balance doesn't help. Paying your statement in full does, and it costs you nothing. 3. Checking your own score is a soft inquiry, free, harmless, and something you should do often. 4. Closing old cards can backfire by raising your utilization and shrinking your history. And 5. Your income isn't part of the equation at all. Only your behavior is. Underneath all of it, your credit score is mostly a measure of one simple thing. Do you pay what you owe, on time, without leaning too hard on the credit you've got? Notice that none of the 5 myths were about working harder or earning more. They were about misunderstanding the rules. Once you see the rules clearly, the game gets a lot easier. Master that one habit, and the number takes care of itself. If this cleared up even one thing you'd been getting wrong, subscribe, because this whole channel is about how money actually works, backed by real sources with zero hype. Next time, we're tackling the credit card minimum payment trap. How a number designed to look helpful can quietly keep you in debt for decades, even while you make every payment on time. You won't look at that little box on your statement the same way again. See you in the next one.